Good day, everyone, and welcome to B2C tutorials. We congratulate you all for making it here. And then today we are going to take taxation. I'm James Nano Fori, and then I'll be your facilitator for today. So today we are going to look at capital allowance. As I said, we are taking tax, but today what we are looking at is what? Capital allowance, which is one of the crucial topics when it comes to what? Taxation. When it comes to taxation, that's one of the crucial topics. Okay. So let's zoom in straight into it. So capital allowance. Capital allowance. In the first place, what is capital allowance? Capital allowance just is just a concept, or is just something that is granted in place of what? Depreciation. I believe we all know depreciation. We all have been working with um our financial statement. We know depreciation, which is what mainly when we look at what the financial reporting, depreciation, a business will charge depreciation when they buy an asset. And then as they use the asset, they'll be charging depreciation to recover what? The amount. But depreciation is very, very subjective. Very, very subjective. One company will charge depreciation at what? 30% reducing balance. Someone will charge 40% straight line. Someone will charge 10%. Someone will charge 5. Someone will charge 2. So depending on the goal that a business wants to achieve, whether they want to make their profit very high or they want to make their profit very low, they can manipulate what? The depreciation. And the governments check the things like, no, no. If we allow people to use depreciation in their tax calculation, I believe we know what will happen. Those who want to pay less tax will maneuver their ways around and all that. So now the government, or from a tax perspective, they are saying what? Okay, no, don't use depreciation. So now we are granting capital allowance, or use capital allowance in place of what? Depreciation. And one thing about capital allowance is, as depreciation is very subjective, capital allowance is what? Standardized. So it's already standardized. It's not now that a business can choose whether to use 10, to use 12, to use whatever. Capital allowance is standardized. So briefly, the concept of capital allowance is just like depreciation. So it is granted in place of what? Depreciation. Take your depreciation away, but we will give you what? Capital allowance in what? In place of it. You have bought an asset, let me say a plant, a vehicle, or something, and then you want to charge depreciation on it. No, when it comes to tax, we don't charge depreciation. You'll be granted what? Capital allowance. That's like depreciation in taxation. So that's what how mostly I term it. It is depreciation in taxation. So that it will be what? Very, very simple for us. So just as I have explained, we'll go much into it. So now, depreciation, sorry, capital allowance is only granted on what? Depreciable assets. Capital allowance is only granted on what? Depreciable assets. When we say depreciable assets, what are we talking about? We are talking about what? Sets, not just anything. Oh. We are talking about asset. And in the first place, asset lasts for what? More than what? 1 year period. In layman's terms, assets are what? Um, Equipment. It can be vehicle. It can be whatever used in a business that exceed what? More than what? 1 year. So they are assets that are used in the production of income from a business. When we talk about depreciable assets, we are talking about assets that what? A taxpayer, let me say if the taxpayer is called Derek. So Derek is a taxpayer, have an asset that he uses in what? In his operation, in his business to generate income. That's what we call what depreciable assets. And these assets are what we grant what capital allowance on. So meaning that if you have an asset that is not depreciable, like land, we all know land does not depreciate, but rather what appreciate. Meaning that what you can't claim capital allowance on it because it is what not a depreciable asset. Please do you understand? We will see more of it as we go forward. And then I've given the concept of what? Capital allowance. So it is the what standardized deductible allowance in place of what accounting depreciation. So just like what you would have been taking from your profit as depreciation, now it is capital allowance. Just that here you don't have the liberty of using what the rate or the method you want. It has been what standardized for you. Now, qualifying expenditure. What we term as what? Qualifying expenditure. What we term as qualifying expenditure. Okay. Very simple. Let me give you the concept. Qualifying expenditure is just what the capital expenditure that's incurred in acquiring what a fixed asset or a depreciable asset. So let me say a vehicle. We bought a vehicle for 50,000. We know a vehicle is a depreciable asset. So the 50,000 that's what we used or the capital expenditure that we have incurred is what we call what the qualifying what that's what we call the qualifying expenditure. Okay. Now, there are some rules when we come to what? There are some rules or conditions when in granting capital allowance. As we have explained, capital allowance is not just granted anyhow. It's not like, oh, there's assets, so let's grant capital allowance. Oh, there is assets here, let's grant. No, there are specific rules that govern what capital allowance. And in examinations, this particular thing is very, very examinable. First thing, first of all, capital allowance is granted on depreciable assets. That's the first principle. Capital allowance is granted on depreciable assets, meaning that if the asset is not depreciable, please don't grant capital allowance on it. So that's the first thing. Capital allowance is granted on what? Depreciable what? Asset. Two, the asset on which or the depreciable asset that we are talking about should be of what? A capital nature. The depreciable asset that we are talking about should be of what? A capital nature. Not you go and buy, like, let me say, an inventory. You know, an inventory is also an asset, but it's not of what? A capital nature. So when you have inventory, can you take capital allowance on it? No, it has to be what? Of a capital nature. So the first thing is it should be, or it can only be granted for depreciable assets. And the second thing is what? It is granted what? On asset of capital nature. Now, the C, the depreciable asset should be owned by the person. So the person who is carrying out the business, let me say it is B2C Limited. We are the taxpayers, and let me say we are calculating our what? Let me say we are calculating our capital allowance. If we have an asset, first, before we can claim for capital allowance, it should be a depreciable asset. Okay, check. Two, it should be of a capital nature. Let me say it is a laptop. So, okay, it qualifies. Three, it should be owned by the person. So you, the taxpayer that we are calculating your what? Your capital allowance, you should own that asset. If you don't own that asset, please, you can't calculate capital allowance on it. These are things we have to pay attention to. If you don't own it, you can't what? Charge capital allowance on what? On it. Another thing, even if you own it, it should be used in carrying on business. You should use the asset in carrying on what? Your business. So it's not only enough for you to own the asset. You should also use the asset in what? In your operations. You might own the asset, but you are not using it in your operations, meaning that you can't charge what? Capital what? Allowance. So you own it and then you should use it. And then the other thing is that You should use it at the end of what? The period. At the end of the period, because that's where we charge capital allowance. It's charged at the end of the period. That time that we are charging the capital allowance, that's at the end of the period, the asset should be in use. Have you seen? It should be used, it should be owned and used by you at the end of the period. So first, it should be depreciable assets. Second, it should be of a capital nature. Third, it should be owned by the person. Fourth, it should be used in the operation of the business. Fifth, it should be what? Owned and used by the person at the end of the period. So it can be a depreciable asset. It can take all the first boxes. You can own it, you can use it. But if at the end of the period where we are charging the capital allowance, if the asset, you don't own the asset or you are not using it at that particular time, then you can't charge. You can use the asset for about 360 days within the year. If only 5 days to the end of the year you depart ownership or you sell it or something or you don't own it or use it, then it means that although you've used it 360 days, you can't charge. So at the end of the period, do you own it? Are you using it? If yes, then we go on to what? To what? To charge capital what? Allowance. Okay. One thing too is that capital allowance is not transferable. You can't say that B2C Limited, for let me say 2025, they charge capital allowance of 5,000. Oh, they don't need the 5,000. So they have transferred the 5,000 to, let me say, ABC Limited for them to take that capital allowance. No, you can't transfer your capital allowance. If you are granted a capital allowance, it's either you take it or leave it. You can't transfer it. And then also, you can't defer it. You can't tell the government that, oh, this year capital allowance was 5,000. No, I want to move it. This 2025, I don't really need it. So you, the 5,000 that you have given me, let me take it to 2026. Yeah, I'll go and charge it there instead. No, it's not allowed. So capital allowance is not transferable, and then also it cannot be carried forward. Okay. So these are the some of the basic rules when capital allowance comes in. When we are looking at capital allowance, these are some of the basic rules. Now we can also look at some circumstances where we can consider um, can consider asset as being used by a person. First of all, I mean, too obvious when you purchase the asset. When you purchase the asset to use it in your operation, that one it's very clear that, oh, okay, you are using the asset. It is for you. That one is very clear. And then also assets in temporal what disuse. Asset in temporal disuse. So let me say you bought an asset, you own the asset, you are using the assets, then maybe your operation, there is a minor fault that operations has come to a halt just for a period of time. Please, the word is what? Temporal disuse. So maybe something has happened, or maybe there is a general meeting, like there is something, a circumstance that has rendered the asset for it to be disused temporarily, meaning that maybe after a period, after 1 month, after 2 weeks, it's going to be used again. That one we consider the asset as still what being in use by the person. And then the next one is, let me say, operating lease. We know that in when we come to accounting, we have operating lease and then we have finance lease. Finance lease is the what that's the long term when you lease an asset for a long term. That one it's assumed that the ownership is transferred to the person who is leasing it. But when you are giving it out on operating lease, operating lease is for a shorter period, mostly 1 year, within a year. It's short term. So that one, although someone is leasing it, because it is an operating lease and it is for what? Less than 1 year, we assume that the asset is still with what? With you. So let me say B2C Limited. Let me say we have a laptop, and let me say we have what leased the laptop to ABC Limited for let me say a period of just 4 months. Having said this is just an example, but this is what an operating lease. So when we are calculating our capital allowance, we can say that oh, that asset is also what part of our asset that we are going to claim capital allowance for because it is what operating lease. Please, if it is finance lease, then please you don't claim capital allowance. The person who is using the asset will claim the capital allowance. Okay. So that was it for circumstances to consider an asset to be in use. Now, let's look at one of the confusing area when it comes to capital allowance. That's what the classes of depreciable assets. I told you that when it comes to capital allowance, everything has been arranged for you already. They've classified every asset already. So that one, you don't have to do any classification or something like that. I'm going to try as much as possible to summarize this classification for you once and for all, for you to understand. Sometimes it's a bit confusing, but I believe that by the end of this explanation, you catch it once and for all. Okay, so to begin with, depreciable assets are grouped into five: class one, class two, class three, class four, and class five. Now, what do we have in class one? Which asset has been placed in pool one? The classes are also called pools. So which asset has been what? Boxed into pool one. Now, please don't think far. When you come to pool one, it is what? Computers and data handling equipment. Computers and data handling what? Equipment. Computers and what? Data handling what? Equipment. So laptop. Laptop is a computer. Uh-huh. We have laptop to be what? A computer. We can have desktop, which is what? A computer. If you have any data handling what? Equipment, that one can also what? Come here. When you see something like a photocopier, a photocopier is not a data, it doesn't handle data, please. Photocopier doesn't handle data. You just put it in there, it will photocopy for you. It doesn't handle data, it doesn't hold data. Let me put it that way. So you see anything computer, or any data, anything that handles data or that holds data, please, it comes to class one. So all your computers. So just know that class one is for computers and then data handling equipment. Class two. When we come to class two is for what? Automobiles. Class two is for what? Automobiles. Just know that your class two is for your vehicles. Class two is for what? Auto what? Mobiles. But there is something that we are going to clarify when it comes to class two. I'm boxing everything in for you. Like we are trying to make sure that we get some few one or two things just so as when we mention a class, we know that okay, this one is for this. So we know that class one is for computers and data handling equipment. Class two, automobiles. But please, class three to have some automobiles. But let me put it this way. When we talk about class two, please know that the automobiles in class two are all the vehicles that pass on what our normal routes. All the cars that pass on our normal routes are what in class two. So we have buses, it pass on road, mini buses, it pass on road, goods vehicle pass on road. So all earth moving what equipment and heavy trucks, all of these are what moving on roads. They are all in class two. But when we come to the other vehicles or other automobiles that does not pass on the road, please, that one goes to what? Class three. So we have what? You can have vessels which are ships. You can have what? trains, you can have airplanes, those all the moving equipment or the automobiles that does not pass on our road goes to what? Class 3. But those that pass on our road goes to what? Class 2. So know that your class 2 is for what? Your automobiles. But because it's very hard that you see in a question that they've written ship or train or airplane in it. But just keep it in mind that it is what? The automobiles that pass on road that's come to class 2. But class 2 is for vehicles. When you hear class 2, hear what? Vehicles. Class 3. Class 3. Class 3 is for what? Equipment. Oh, sorry about that. Class 3 is for equipment. Every equipment, all equipment, office furniture, whatever equipment that you see. Know that class 3 is for what? Equipment. You see, plant and machinery, it goes to class 3. But there is one particular thing. You see, I told you that equipment goes to what? Class 3. Plant and machinery, class 3. Please, plant and machinery only goes to class 2 when it is the plant and machinery of a manufacturing what? It is the plant and machinery of what? A manufacturing company. That is the only time that a plant and machinery will move from class 3 to class 2. Only when you are dealing with what? Manufacturing company. So when you are reading the question, you have to be very careful to see if the company you are working with is a manufacturing company. If not, then fine. Every equipment, every plant and machinery goes to class 3. It is only when it's manufacturing that the plant and machinery will go to class 2. So note that your class 3 is for what? Equipment. And then also, the class 3 is also a special class. Why do I say it's a special class? When you have a depreciable asset, and then you have looked through all the classes, and then you don't have any class to give to that particular asset, bring it to class 3. Class 3 is a generalized class. When you are not finding the thing anywhere, please put it in what? Class 3. Meaning that when you're a bit confused about where to place an asset, you can you've seen the asset. Hey, this asset it's not computer, oh. It's not data handling equipment for me to go and put it at class 1. Okay. This asset, it's not automobile, and it's not equipment for plant and machinery that I can go and put it at class 2. You've checked class 4, checked class 5. You can't find any, it's not there. Then you put it at class 3. So if you are not finding it anywhere, you put it at class 3. Now, class 4. Class 4 is what? Buildings. Buildings and work of what? A permanent nature. Buildings and work of a what? Permanent nature, except of any of the things that have been mentioned in what? Class 3. So if you have equipment, work of a permanent nature is what? Works that you can't move them. But if it is equipment that has been fixed, maybe in a company that they are using in their production, please, that one is not what? Class 4. That one is in class 3 because it has been specifically mentioned in class 3. So, but buildings and work and structures and what works of a permanent nature all goes towards class 4. So you have buildings, class 4. Signposts, class 4. If you see signboard, please, class 4. Because it is a work of what? A permanent nature. Can you move a signboard? I'm just waiting for who can move a signboard. If you're able to move a signboard, just record yourself and come for your bonus. I don't think anyone can push a signboard off. Okay, so this is for class 4. Then when we come to class 5, it is what? Intangible assets. No libi, no laba laba. Class 5 is for what? Intangible assets. But it does not include goodwill. It does not include what? goodwill. You know, goodwill is very subjective, very, very, very subjective. There is no cash flow, there is nothing. So capital allowance that or the tax does not recognize goodwill for us to grant capital allowance on. So now these are the classes. These are the general ones, like the general things you can easily identify them with. Class one, computers, and then your data handling equipment. Class two, automobiles. Class three, equipment, plant, and machinery. It is only when the plant and machinery is for a manufacturing company, that's when you put it in class two. Then what? Four. Your four is what? Your buildings and work of permanent structure. So what? Buildings, class four. Then class five, we have the intangible assets. Very, very simple if you take it this way. Now, there are percentages that are what? Attributed to all of this. When you take class one, it start from class one coming. Very simple. See, class one is 40%, class two is 30%, class three is what? 20%, class four is what? 10%, and then class five is what? Useful life. So have you seen how the thing is ranging? For you to remember it very easily, 40, 30, 20, 10, and then the last one is what? Useful life. 40, 30, 20, 10. Then we have what? Our useful life. So that class one, class two, and class three, that's one, two, three. That one, they use what? Reducing balance. So the 40% is reducing balance, 30% reducing balance, and then 20% reducing balance. That's for class three. Now, when you come to class four, the 10% is what? Straight line. And then the class five to it is what? Useful life. That one, you have the cost, you divide it by the useful life. So that one is also considered to be a straight line. Now, one important thing, when we come to class one, class two, class three, or pool one, pool two, pool three, please, we have something that we say that we pull all the assets together. Why do we say this? If you are having, let me say in a question, you are having about, let me say, class one, the company has bought Toshiba laptop, they have bought Apple laptop, they have bought Acer laptop, they have bought um what are the likes? Lenovo laptops. So let me say they've bought about six different types of laptop. Please don't go and list that. Oh, Lenovo laptop, Apple laptop, Acer laptop, Toshiba laptop, HP laptop. No, for pool one, pool two, pool three, whatever is in the pool, we bring them together. So all the laptops that you have bought, all the computers that you have bought, all the things that fall in class one, please add all of them together and then report on it as what? Class one. When you bought about 4 or 5 vehicles, please, you don't do Nissan, we you don't do Nissan, Range Rover, Land Cruiser, and then no, no, no. Please, you bring all of them together as one figure. The same for class three. But please, when we come to class four and class five, assets in there are not pulled together. So let me say we had an office building, we had a warehouse building, all in the same year. We have to report on what? The office building separate. Then we report on the what? The warehouse to also what? Separate. Then the intangible assets to which is class five to they stand on their own. So if you had trademark, you had patent, you had copyright, they all stand on their own. For four and five, we don't put them together. But one, two, three is what? It's actually what? Pulled together. Okay. Now, how do we calculate for capital allowance? We'll be doing more of this when we get into the calculation, but I want you to have a fair idea. I want you to have a fair idea of how we calculate what? Capital allowance. So at the end of the period, if you want to see your capital allowance or the capital allowance that you want to charge, it's very easy. I know sometimes we just multiply the rate by the value in the pool and then we get the answer. I mean, that's totally correct, but that's only correct when the period that we are looking at is a full period. So if it is the whole 365 days, we have operated in all the days. Now we have a full year. That one, when we are multiplying straight, it is correct. But the problem comes in when it is not a full year. Let me say you've worked only 6 months within the year. You've worked only 9 months within the year. So with that one, you can't use the straight up multiplication. You have to use the formula. And it's a very simple formula, as you see on your screen. We have the A. So we have the times A times B times what? C, all divided by 300 and what? 65. Where A is what? Mhm. So A is what the value of the pool. Let me say you've done all your additions, if there are subtractions, so you've done all your adjustments. The value that you get at the end of the period, the one that is subject to capital allowance, you have A, what? That will be your A. And then the B, and then the B will be the rate. So if you are doing it for pool one, it will be what? 10%. Sorry, 40%. When we are doing it for pool two, it will be what? 30%. We are doing for pool three, that will also be what? 20%. So that's what the B. And the C is what? The number of days. So let me say a company that started have worked only, let me say 92 days in the year. That one, this C up here will be what? The 92. That's when we are doing the actual formula. We not write C, we write what? 92. But in the case where it is a full year, that one you see that this C is what? 365. So you have the A, let me say if A is 50,000 times, let me say it's computer, so 50,000, let me say 50,000 times it is computer, so 0. What? 4, which is 40%, times 365, all divided by what? 365. So because it's a full year, have you seen we have 365 here as a numerator, and then we have it as a denominator. So the denominator will actually cancel the numerator. Then we'll have only the 50,000 times what? The 0.4. You see, that's why I told you that when it is a full year, you can go for it to do the simple multiplication, then you get your answer. You see, it's because the 365 will cancel the 365. So when it's a full year, you can go ahead. But please read the question very well. Mostly when the year starts, sorry, when the business commence and when it what ends is very important. So with that one, when you use the formula, you still get the same answer. But please, if the number of days is not up to the 365 or it's not a full year, please, you have to go by the formula. Okay. So this is the formula we use to get capital allowance. You assume you get more insights when we are doing solving our calculation question. Okay. So what else? Uh, let's go on. Okay, so these are illustrations. We've talked about this, how these are done. Okay, so let's talk about disposal of what? Fixed depreciable assets. It's very simple. When you dispose of what? A depreciable asset, what do you have to do? It is what? The amount is what? Deducted from the written down value of what? The tool. So let me say computer have a written down value of, let me say, 50,000. And let me say in that year we bought additional computer for, let me say, 3,000. And then we sold the computer for what? Let me say 2,000. Meaning that we started with 5,000. We got an addition of what? 3,000, making 53,000. We sold the computer for what? 2,000. So the amount that was what sold for will actually be deducted from what? The written down value. So we have 50,000 plus the 3,000. Uh, yeah, so let me say 53,000 minus the 2,000. So now you see that the written down value was 51,000. And that's what we will charge the capital allowance on. You will see more of that when we when we start the calculation. And also, let me say, if an asset is for, let me say, 5,000 and you sell it and then you get, let me say, 6,000, obviously you've gotten more than the written down value of the asset. When that happens, you can't come and deduct all the 6,000 from the written down value. No, because what has been recorded there for the asset is 5,000 and you can't come and deduct all the what 6,000. What do we do? Please, the excess income. So let me say it was 5,000, you sold it for 6,000, meaning the excess is what 1,000. That excess is actually added to what the taxpayer's income. So it is only the 5,000. So in the written down value that there is 5,000, it's only the 5,000 that you take off. What does this mean? We are just what removing the asset from the written down value. So if the thing is 5,000, it's been recorded as 5,000, and you come and take 6,000. Well, remove your answers where you account. No. So you remove just what is there for the 5,000. The excess goes into what? The excess goes into, how do we call it? It's treated as what? Your income. But also, when let me say in pool one, we have about six assets in pool one, and then we sell all those assets. We sell everything. It was 50,000 that we have in pool one, and then we sold everything, and then we got 45,000. You see, we've made a loss. We've sold everything. Oh. It was 50,000, we got 45,000, meaning that there is a loss of what? 5,000. What will you do? Are you going to subtract the 45 from the 50,000? Then it will be in your books that the written down value is now 5,000. But ask yourself, you've sold everything. So what's the 5,000? What is it attributed to? So what do you do? When you sell everything in a particular pool and then you make a loss on it, whatever the loss is, since you've sold everything in the pool, you have to grant an additional what? Capital allowance. So the 5,000 that is left, you grant an additional capital allowance to bring the pool to what? Zero. Because you've sold everything. You've actually sold everything. So what? You bring the pool to zero just because nothing is in there. So the figure two, nothing should be there. Please, do you agree? I know you agree with me. I know. Now, one thing when it comes to capital allowance, we are talking about class two, the pool two, we said it's vehicles. But you see, when you buy a vehicle as a company and you want to charge capital allowance on it, please, if the vehicle is not a commercial vehicle, so if it is not a commercial vehicle and it is a private vehicle, then the value that you record shouldn't exceed 75,000. So meaning that I can buy a vehicle, B2C Limited can buy a vehicle for, let me say, 100,000 Ghana cedis. But because if it's not a commercial vehicle, we'll look at what a commercial vehicle is. If it's not a commercial vehicle, we cannot record all the 100,000 in our books. No. For capital allowance purposes, we can't record all the 100,000. We have to limit it to what? 75,000. So if we buy the vehicle and it is 70,000, what do we record? Now we can record all the 70,000 because it's not up to the 75. The 75,000 is what? The ceiling. That's what? The ceiling. Now, how would you see that a vehicle is not what? A commercial vehicle? So it means that if a vehicle is a commercial vehicle, then it means that it carries a load more than what? Half a ton. If it carries a load more than half a ton, then it is a commercial vehicle, meaning that if it carries a load less than a ton, then it is a private vehicle. Also, if the um if the vehicle can take more than 13 what persons, it can take more than 13 people, like 13 people can board the vehicle. Then it means 13 or more, it means that it's what? A commercial vehicle. Now, if it is less than 13, we have 12, 11, 10. Okay, then it's not a commercial vehicle. And once it's not a commercial vehicle, then the limit of 75,000 what comes in. And then also, if a vehicle is used in what? A rental or a transport business, it is automatically what? a commercial vehicle. If you use a vehicle, so even if the vehicle is 10,000, if you are using it in a rental and what rental or transportation business, even if it's 10,000, even if it's 1 million, please, the restriction will not apply because it is totally what automatically what a commercial what vehicle. Okay, okay. We've talked about the gain and then the loss. Okay. So now when you have an asset and that asset is destroyed, the depreciable asset is destroyed by what a disaster, or someone has stolen it, or whatever has happened to it, it has rent, like someone has stolen it, it has been destroyed by accident. What do you do? If you have the proof, if you can prove it. So when the question comes, the question has to give you a proof that someone has stolen it or it has been destroyed by a disaster. If there is a proof, then please, if the asset, the value is, let me say, 10,000, you can take the 10,000 from the written down value. That you can deduct it as if it has been sold. Please, if it's destroyed by accident or it has been stolen, if you have the proof, you can take the what written down value out of the pool as if it has been what sold. But please, if you have insured the asset, let me say my car, let me say I have a car and the car is, let me say, 30,000, or the car is, let me say, 40,000, or let me say 10,000. Someone have stolen the car. So I want to take the 10,000 from the written down value. Okay. Now, if let me say insurance actually gives me I've insured the car and they give me part of it or whatever. I have to what treat that one as what proceed from what disposal. So we assume that you have disposed it. Okay, it was 10,000. You are going to deduct all the 10,000, but oh, insurance people give you 5,000. It is a compensation. So please, you have to deduct that 5,000 from the 10,000 so that the thing that you can deduct, the loss that you have actually suffered is what 5,000 because it was 10,000 although, but the insurance people has given you part of it. So you can't come and take everything. We are not for that Christmas. Okay. Now, you see, some companies also enjoy tax holidays. Some people are fortunate enough they enjoy tax holidays. Okay. If I'm enjoying a tax holiday and I buy an asset, what happens to it? You know, I don't pay tax or I pay concessionary rate, which is sometimes 1%. That one, they will not give me allow deduction for capital allowance. But if I buy an asset during the tax holiday period, please, although you are not, you can't charge capital allowance, but what do you do? The assets, you are not paying tax and you want to deduct capital allowance for what? But you have to be calculating what the capital allowance and be deducting it from what the written down value of the asset or of the pool. Because let me say, if your tax holiday is for 5 years, at the end of the 5 years, you know that now you pay tax now and you will be charging what capital allowance. Please, you have to charge the capital allowance based on the value of the asset as at the time that the tax holiday is off. Let me use figures to explain this. So let me say in 2020, let me say B2C Limited got a tax holiday. So let me say during that period we bought a laptop which is what 10,000. And our tax holiday is for 5 years. So it means that we are going to start paying tax in what? 2026. We can't say that because we are not paying tax, so we are not granting capital allowance. We can't say that this 10,000, nothing will happen to this 10,000. So when we get to 2026, then we start charging capital allowance on the 10,000. That same 10,000. No, it's not done that way. You have, when you are in 2020, the time that you're enjoying the tax holiday, you have to what? Charge or calculate your capital allowance on this amount and be reducing it yes, and when you move through the years. So if let me say the capital allowance that they would have charged in 2020 was um let me say 1,500. That's 2020. It means that the value of the asset in 2021 will be what? Somewhere 8,000 what? 500. If in 2021 too, it was the same 1,500, it means that in 2020 the value will be what? The value will be, let me say, 7,000. In 2023, the same 1,500. So now the value goes down to, let me say, 5,500. In 2024, it goes down to 2024, let me say it goes down to 4,000. 2025, it goes down to, let me say, 3,500. So it means that in 2026, we are starting with what? A written down value of the laptop of what? 23, 35, sorry, 3,500. This is the value of the what? Asset. That's at 2026. So although you are not being granted capital allowance, you still have to be charging it so that you know the written down value of the asset. Because when you are done with the tax holiday, you don't charge the tax on what? The cost. No, you charge the capital allowance. Sorry, you don't charge the capital allowance on the cost, but you charge it on what? The amount, what? As per the written down value. So here now in 2026, every capital allowance that we have to charge will be on what? This value, this 3,500, rather than what? This 10,000. So you don't wait and say, oh, we are not charging, so let's wait after the period, then we charge it on the original cost. No, it's not what? It's not done that way. Okay, okay. So that was it for this part. Let's go on and then see what is in it for us. Okay, so let's go to the next. Let me simply go to the next. Okay, okay, okay. So we have something that we call a sales and lease back transaction. If you sell something to someone and then you lease it, you let me say B2C Limited, we have a laptop, we sell it to ABC Limited, and then we lease it at the same time. Know that the rules on the operating lease and the finance lease still applies here. So if let me say we are leasing the thing, we sell the thing, we are not the owners again. ABC Limited is the owner. So if the owner is leasing it on operating lease, then you know that it's the owner who will be charging capital allowance. But if it's a finance lease, then you know that the person using the asset will be the one to charge capital allowance. Also, when in high purchases, how do we charge capital allowance in high purchases? You know, high purchases when what? You are buying an asset, but you do what? The asset is what? The payment is in what? You opt for a bullet payment. You don't make you don't make the payment in a whole. So let me say if it's 10,000 or 100,000, you pay 25,000, maybe at the end of the month or at the end of the year, another 25,000. So it's what installment, what payment. The capital allowance, when you are doing that, the capital allowance will not be granted to you on the whole amount. If it's 100,000, that we are granting you capital allowance in the whole amount. No, on the whole amount, no. It is we grant you the capital allowance based on the amount that you have paid. So if it is the ending of this year and the thing is 100,000, but you have paid only 25,000 of it, it is that 25,000 that will grant you capital allowance on. When you pay 50,000, will grant you on the 50,000. So it's not the holistic amount that will grant it on it for you. It is based on what you actually pay. Asset acquired in stages. So let me say you have an asset, let me say a building, you know, a building, a three-story building, maybe a business might like to build it and first start to use the first floor you start use the ground floor, and then later on, maybe next year, they'll build the next floor and use it. When asset is built in stages, please, just like what we saw in the high pitches, it's not granted on the holistic amount. It is what the asset where you've gotten to. Let's grant you the capital allowance on that one. When you get to the next stage, we will grant it to you. We don't want to grant it on everything so that you will be doing the first stage and then you still be enjoying what everything. No, wherever you are, that's where we grant you what the capital what allowance. Wherever you are, that's where we grant you what the capital allowance. Okay, so most of this has already been discussed. How the pool system work. We've already talked about the pool system. Okay, one thing that we also have to talk to about is whenever you have a pool and then the written down value of the pool is what? It's less than 500 cedis. It's less than 500 cedis. Mostly, even if it's 500, it's less than 500 cedis. So it's 499. If the written down value of the pool is less than 500 cedis, please grant additional capital allowance and bring everything to zero. Bring the pool to zero. So let me say pool 3. At the beginning of the year, let me say the written down value was, let me say, 800. And then the 800, we charge the capital allowance, and the capital allowance was 300. So we before we can get the written down value of to send to the next year, we have to less the capital allowance from the opening written down value. So it is 700 minus what 300. You see that after that, the written down value will be 400, and it is less than 500. Whenever you see a written down value less than 500, grant additional capital allowance and bring that written down value to zero. So the 400 that we will have, based on the example that we gave, we have to grant what additional capital allowance of what 400, and then now we have what it will be 400 minus another 400. Now the written down value will be what zero. So it's either 500 CD and upward or nothing. Okay, thank you very much. So that's for the pool system. Now, the capital allowance for mining and petroleum operations are actually a bit different from what we have discussed. What we have discussed is for any business at all except petroleum and then what mining. So what's that different about petroleum and mining? So it's just that you see in the other business, just like we've discussed, we have 5 pools. But for petroleum and mining, all the what initial, all the assets, like all the things that have to be granted, capital allowance have to be granted on it. All your assets, all your initial amount, for petroleum, before you start producing, all your prospecting and other costs is what is actually grouped, and it is placed in the capital allowance. We'll delve more into that when you are solving more questions. So all capital allowance item in petroleum and mining is actually what placed in one pool. So there they don't have pool 1, pool 2, pool 3, pool. No, no, no. It's only one pool. And then what? It is what? 20% straight line. The capital allowance is 20% what? Straight line. We don't have 40%, 30%, 20%, 10. No, 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 no. We don't have anything like that. Everything is placed in a separate pool, like one pool, and then what we charge what 20% what reducing balance. And here you see that when we're doing the other business, we said that when you receive a consideration for selling an asset, what do you do in the other business? Just like we discussed, you deduct it from what the written down value of the pool. For petroleum, you don't do that. When you sell an asset, the consideration goes straight to your income. It doesn't have anything to do at all with your written down value. So, and also when we come to petroleum, every petroleum operation is what is is treated differently. Every petroleum operation is treated differently. So you have, let me see, petroleum operation here, they have their own capital allowance. Petroleum operation there, they have their own capital allowance. So just as we've said, here too, capital allowance cannot be carried forward, and then it cannot what be transferred. So it's the same for the mining as well. Goodwill and land, I've already talked about it. I said goodwill is very subjective. We don't grant capital allowance on it. And then for land, we don't grant capital allowance on it. Why? Because because land does not depreciate. It's what? Appreciate. Okay. So thank you very much. And then thank you for being with B2C, where quality is well assured. So thank you. We've dealt with the theory aspect. The next time that we'll be meeting will be for the calculation aspect. So thank you very much. If you have any question, in our next class, you can bring forth all your questions and I'll be ready for you. Thank you very much and have a nice day.